How much money do you make an hour? How about your parents? There's a good chance that nobody has ever bluntly asked you either of those. Also, you may not know the answer to the second question because you either never asked or your parents straight up won't tell you. People are kind of weird about money, and I get that. It seems personal, and it would be infuriating if you found out the person doing the exact same job as you was making 30% more than you did. Or if your friend bought the same car as you and had paid thousands more despite getting the exact same thing at the end of the day. People do not get much experience talking about money in their day-to-day lives, so let's break things down in a way that won't get awkward for us. Today, I'm going to discuss some core ideas in the world of personal finance, and fortunately, since neither of us know each other personally, it can't get that awkward. If you find out that you've made a massive mistake in either the past or are currently doing so, there's no judgment. If I'm just here to confirm your shrewd financial move, all the more power to you. Specifically, we're going to talk about two opposing ideas, income and expenses. They're fairly straightforward, so you don't need to be intimidated, but they are the bedrock of your financial future. So taking a few minutes now to learn about them more in depth can massively improve your life in both the short and long term. Simple concept, critically important, it's an easy win for you. Starting with a concept you're probably most familiar with, income is just any new money you have today that you did not have yesterday. Most people generate their income through a job or self-owned business, but it also includes any other means of getting new money. As a kid, you probably received birthday money, found $5 on the ground, that's income. Selling drugs is considered a source of income, although unless you're a pharmacist, I'm going to recommend against it, as you'll find it's quite difficult to make a healthy income while in prison. Maximizing your income is one of the most direct ways to improve your overall financial well-being, but it's also one of the more difficult things for you to manipulate in the short term. More than likely, you will need to give up your time now for additional income by working longer hours, or attempting to increase your hourly wage by either asking your boss for a raise, promotion, or finding a better paying job elsewhere. Unfortunately, this is much easier said than done, as it's one of your boss's priorities to make you work as much as possible for as little as possible while keeping you from leaving for another job entirely. Every dollar an hour extra that you make, the organization you work for loses, and they are well aware of this fact. This is not to say that your manager is necessarily a cold, money-hungry human being. You simply have different incentives mandated to you from your place of work. For example, your incentive is to work as little as possible for as much as possible. If someone were to offer you $1 million for a single hour of work per year, chances are you're going to take them up on that offer. While your manager, on the other hand, would similarly take 1 million hours of you working for $1 per year if you offered it to them. Everyone is simply looking out for their own income at the end of the day, so recognizing you are not the only one with income concerns gives you a bit more context on other people's motives inside the workplace. While increasing your income as a short-term goal can be difficult or have only minor impacts, you do have a lot more control in the long term. Simply working increases your level of experience, which is inherently valuable to employers. Going back to school from a single class related to your current job to overhauling your entire career path will take some time, but can provide large payoffs. Simply making more connections within the industry you work in can pay off. You need to hone in on the right people and make deeper personal connections. You do not need to employ every strategy to increase your income in the long term, but the more you tackle now, the larger potential payoff there is down the road. Focus on your strengths where you can. If you're an extrovert with little money for school at the moment, building a rapport with the higher ups will likely be your best strategy. If you find executives around you to be unapproachable for whatever reason, find another tactic with more potential, such as starting a side business in your spare time. If you do own your own business, expanding your client base or offered services will be your version of working longer hours or asking for a raise. Your clients do not want to pay you more for the same amount of work they're getting right now. So again, these can be difficult goals to achieve, but they are your goals nonetheless on the road to maximizing income. In the longer term, offering a more diverse set of goods and services will expand your business, but can take an investment of your time now for a potential payoff later. Self-employment is a bit more risky in this way, as there's no guarantee someone's going to want to buy what you're selling in the first place. But as we'll learn soon, the more risk you take on in the world of finance, the higher the returns can be. While working income, either for yourself or others, is by far the most commonplace, there are many other forms of income available to you whether you know it or not. If you keep your money in a bank account, for example, believe it or not, you're making a small amount of income through that. The account will have an interest rate attached to it that pays you at the end of every month. The more money you have in the account, or the higher the rate, the more income that is. Now, before you go running to put every last penny you have into a bank account, you should know that these are some of the safer but smallest sources of income available. A more lucrative way to generate income with money you already have is going to be through investing. As a general rule of thumb for investing, you should know that the more risky your investment, the more potential there is for you to make and lose your money. Risk equals reward. Just as jumping out of an airplane is a risky but rewarding life experience, staying at home to watch a movie is a relatively safe but less exhilarating choice. The lowest risk investment you can make is going to be loaning your money to a government in what's called a bond. Just like your bank account, the government will give you interest in exchange for you letting them hold on to your money. However, you will not be able to turn that bond back into spending money as easily as you can go to your bank for cash. Just like loaning your money to a government, you can also loan money to a business, but while the government will almost always be able to pay you back, businesses have a bit more added risk to them. They can go bankrupt before the bond has matured. If that happens, you're probably going to lose some money, plain and simple. This in turn makes corporate bonds a little more risky than government ones, but in exchange for your added risk, the business will give you a higher interest rate for you trusting them to hold on to your money. The final type of investing we'll touch on here, although there are many forms we will not discuss, is by purchasing stocks. Stocks are simply tiny slices of ownership in a company, and owning a stock gives you the right to sell that ownership later for a potential gain or loss compared to what you originally bought it at. Unlike bonds, there is no set time frame you need to wait for before you get your money back. You can buy a stock and sell it 1 second later, or hold on to it years and even decades if you really want to. Stocks can also provide income in multiple ways. Some companies pay you simply for owning their stock in the first place, and the value of the stock itself can rise so you can sell it later for more than what you paid for it now. While there are many other ways of amplifying and diversifying your income streams, there are simply too many to get into right now for a basics video. For now though, you should understand that the most common streams of income available to you are through employment, self-employment, or investments like stocks, bonds, and even bank interest. While winning the lottery and finding money on the ground are also considered income sources, it's probably best not to count on them as a stable foundation for your financial future. Also, if you're playing the lottery and having financial troubles, please just stop playing the lottery. I'm not going to get into the math right now, but trust me when I say it's a losing bet. We now have a solid understanding of the main types of income out in the world, so we'll flip the entire thing on its head and move on to the enemy of income, expenses. Just as income is any money you have today that you did not have yesterday, an expense pulls money you had yesterday out of your hands today. Your largest expense is most likely paying for your survival in some way. You need a roof over your head, which is going to cost you either rent or mortgage. Don't forget to add water, heat, electricity if that's not already included. Plus, you probably need internet to watch personal finance videos on YouTube and a phone on top of that. If you have income, you will need to pay taxes. Transportation is another expense, so add in car, gas, insurance, or at least some money for other means of getting around. Like to eat? Me too, so we'll need money for groceries and eating out at restaurants if we have the cash to spare. Now that we have our basic survival needs met, we can worry about entertainment, like streaming services, going out to the movies, hobbies can get expensive, and any other way you like to keep yourself occupied. Minus the lottery because we stopped playing it. While you have little control over your income in the short run, you do have much more control over your expenses in the short run. Getting rid of excess spending can be done literally today if you need to. Going out to restaurants is more expensive than cooking at home. Some forms of entertainment are less expensive than others. The key to lowering certain expenses in the short term boils down to willpower. Do you have the willpower and desire to say no to spending money when you know your income cannot support it? If you have the sustained willpower to say no when you need to, you will almost instantly be putting yourself on a more stable path in financial future. Don't get me wrong, saying no is hard, so I do not use the idea of testing your willpower lightly. It's just easier than convincing your boss to hand you more money, and can be done faster than waiting for investments to pay off. There's one more big expense you may not be expecting here, and that is interest. By now, we've only discussed interest in the way that your bank, government, or companies will be giving it to you, but trust me when I say that they can take it from you if you let them, and they absolutely will. If you have a mortgage or other loan from a bank, you'll notice that the interest you pay the bank is a lot higher than the interest that they pay you, and this is no mistake on their part. If you're financing a car, the same thing applies. They have the financial power in this situation, and every single time, they will pay you less and make you pay more. Worse than a bank or car loan is interest on your credit card, either when you take cash out or do not pay off the balance at the end of the month. Worst of all is a short-term loan from a payday loan service. If you have this type of debt, you should be begging your bank to give you a loan at a lower interest rate so you can pay off high-interest debt immediately and never look back. Just as all income is not created equal, so are expenses. The interest expenses on credit cards and payday loans are the worst expenses of all. I'll keep the math to a minimum in this video, but you need to understand how horrific certain types of interest expenses can be working against you in the shadows. We will start with you going to the bank needing a boost in income of a nice clean number, let's say $1,000, and every month you'll have the ability to pay off $100 on that balance. The only other piece of information we need to know before we start is that all interest percentages quoted to you are going to be something called annualized. Just basically means yearly. No matter what, when a bank, credit card, or whatever company shows you an interest rate, that is the yearly interest rate. Whether you're borrowing for a week, a month, or 10 years, that percentage is annualized. Fortunately, we can easily turn that into a monthly rate by dividing it by the 12 months in a year, or a daily rate by dividing it by the 365 days in a year. Okay, back to the example. You owe $1,000 and will be paying $100 every month until the loan is at $0. If you owed that to a bank at say 3% interest, we will make it monthly by putting 3% over 12, which is 0.25%. We will then just multiply that by the $1,000 we owe, which adds $2.50 onto your balance, but you're paying off $100 at the same time, so at the end of the month we owe $902.50. Same thing for next month. Take the 0.25 we already know about and multiply it by that $902.50. Hold on a moment. Did you see what I just did there? Don't worry if you didn't, it's a little sneaky, but the more perceptive of you may have just noticed that I'm charging you interest on the $2.50 interest that you've already been charged. That doesn't seem fair, does it? Well, smoke my salmon and call me Sally, the unfortunate reality is that virtually every dollar you owe a bank or financial institution will be calculated this way. It sucks, I know, but just as they can use it against you, there are ways for you to use it against them that we'll discuss in another video. Back to our regularly scheduled programming. Same thing for next month. Take the 0.25% we already know and multiply that by $902.50, which is $2.26. So $904.76 total this month. Take off the $100 we are paying off and we are down to $804.76. Keep doing this over and over and over again until in month 11 we owe only $13.96. A $0.25% of that is only 3 cents, not bad at all, so we can pay the entire $13.99 and be free and clear of the loan. When it's all said and done, we'll have paid a total of $1,013.99. But we started with $1,000 in income, so we've really paid a total of $13.99 in interest to borrow that $1,000. It's not always this clean, as we'll see in a moment, but this is a nice clean example to get us started. Now we're going to up the ante. Same scenario, a $1,000 boost in income this month, but this time we're going to use our credit card at an ATM and they're going to charge us 21% annually until it's paid off. To get that annual percent down to monthly, we divide by 12 just like we did last time, so it's 1.75% per month. From here, it's the exact same steps as the bank loan. Take $1,000 we owe, multiply it by the 1.75% interest rate, and the credit card company is going to add $17.50 in 1 month alone just for the privilege of using that credit card. Hold on a moment. That's more than we paid the bank in interest in the entire 11 months we took to pay it off. And you know that the next month they're going to be adding interest on top of the interest just because they can. Welcome to the dangers of credit card debt. If you've ever heard warnings about the dangers of credit card debt, you now know how they weren't kidding. It can get bad, really bad, and you're right to have a fear of it. This type of expense can eat away at your hard-earned money quickly and quietly. You need to pay attention and take action to avoid or work against this type of expense if you have the means to do so. It is critical that you pay off your credit cards in their entirety every single month without fail. If you do not have the means or discipline to do so, honestly, just take your credit card out of your wallet right now and put it in a kitchen drawer at home, or better yet, cancel the card altogether. This type of expense can cripple you in the long run. Anyways, let's finish off this example. So, they're going to charge $17.50 in 1 month alone, but you're going to pay off $100, so at the end of the first month you really owe $917.50. Same process for next month. Take the last balance we had and multiply it by 1.75% for a total of $16.06. Take off the $100 we're paying this month and we're left with $833.56. Just like last time, we'll keep doing this over and over and over again until we find in the 12th month that we owe only $8.78. Fortunately, it's just a few pennies in interest this month and we can pay off the total $8.93 total at the end of the month and we are done with credit cards. In the end, we paid back $1,108.93 for the original $1,000 income boost that we needed, or $108.93 in interest alone. That's almost 8 times more expensive than the bank loan was, even though the interest rate difference was only 7 times as large. In short, the math works out because the interest we are charging on the interest, but that's not the important part. The important part is that you realize how sneaky and dangerous this type of expense can be. I know I sound like I'm beating a dead horse here, but it's solely because of how insanely important this core concept is. Final example, I swear, and it's just to put the true fear of God into you. Let's say that you borrow $1,000 from a payday loan service at 120% annual interest. Honestly, that's pretty low as far as they go, but we pay it off the same as all the others. I know it's not exactly how payday loans work, but humor me for a moment here. Just as before, we divide 120% by 12 for our monthly rate of 10%. Take the 10% and multiply it by 1,000 we owe, and it comes to a nice clean $100 extra. So we owe 1,100, but we're paying off $100, so at the end of the month we owe $1,000. Hold on, that can't be right. Let's do another month. 10% interest on $1,000 is $100. Add it to what we owe and pay off $100, and we still owe $1,000. Another month. Another month. It is never ending. We can do this for 3 years and never get further ahead than where we are now. What if we need a sick day and miss 1 month's payments? Okay, just $10 extra in the first month, and it's $11 in the second, $12 in the third, and it's fundamentally impossible to pay off this loan under our current circumstances. This relatively tiny $1,000 expense without some sort of emergency intervention has now effectively bankrupted you. There is zero hope of ever getting out of this hole unless you convince a bank to help you out at a lower rate. Hell, you should even take a credit card company's help in this scenario if the bank won't help you. Never ever get a payday loan. Play the lottery before you get a payday loan. At least you can hold on to a sliver of hope of winning if you do. Whoa, that got really dark for a moment. Sorry about that. It's just we're going over core concepts, and it's really important to me that you understand how important and potentially dangerous this stuff can be. We've learned about 2 fundamental ideas you probably heard of in the past but may have not taken a deeper dive into before. Also, don't be worried if you're not fully grasping everything I'm saying in one watch. By all means, watch this video multiple times if you need to, watch other videos on personal finance, do whatever you have to do. You're here to learn and improve yourself, which is a noble goal. I'm just here to help. The only thing I'll ask in return is to hit the like button so others like you can more easily find this video, and subscribe if you want to stay in the loop when I make new videos to help you in the future. In the next video, we'll expand on how income and expenses change your life in the longer term by looking at 2 new terms, assets and debt. It's just a small leap from income and expenses to learn these new concepts, so you don't need to be intimidated. As always, I wish you the best of luck on your journey of increasing your financial well-being, and have a great day.